we are going to discuss about the most important, most hot topics in the market now. I think you guys still remember previously, 2-3 years ago, the most hot topic in the market is surrounding about the coronavirus issue. So after the coronavirus issue is already stable, people is already digest this kind of coronavirus issue news, then it come out with Russian and Ukraine war that's surrounding the market. So a lot of investors keep digesting the news regarding Russian and Ukraine and try to better allocate their portfolio by using the Russia and Ukraine news. But for now, the central bank and the interest rate thing is considering the most important thing now after the COVID, after the Russian and the Ukraine, and now we are going to focus on the central bank and the interest rate. I think you guys will realize that recently a lot of news are surrounding with economic data, and then what's the Federal Reserve says, and what's the central banks come out and provide some statement. So this is a very, very important topic for all the investors. So I hope after today's webinar, next time when you look at the news, it will be able to help you guys to easily digest what happens in the market right now. Okay, so this is important. So we are going to start straight. So the first point is regarding what is the central bank. So central bank, we do have Federal Reserve from the United States. We do have European Central Banks, ECB from the EU regions. We do have Bank of England, Bank of Japan. This kind of something like very professionals, very mature institutional. Actually, their job is not that difficult. You need to think in a simple form. So from central bank's point of view, they actually only have two jobs, which means that their main goal is either increase the interest rates or decrease the interest rate. So before we go through why the central bank is going to increase the interest rates, decrease the interest rates, we need to understand the importance of the interest rate first, and then we will go through about how will it affect the central bank decisions to either increase the interest rates or decrease the interest rate. So before we go through all this storyline, I hope you guys to understand. I hope you guys to briefly understand about how does the interest rates affect the markets. So it will provide you guys a more motivation to learn about the interest rate thing. So for interest rate, right, they're actually like a very simple thing to understand. You need to understand interest rates equals to the risk-free returns if you are going to invest in that country. Risk-free returns example is like when you are going to save money in the bank, right? Your bank is going to pay you some of the interest, which is what we call the deposit rates. So if you like, I'm going to save $1,000 in my bank is going to pay me sometimes the banks might pay you like around 3 to 4% of interest. So you might receive around like $40. So you need to understand interest rate as a risk-free return that investor put their money to save in the bank. So why does the interest so important is because since this is a risk-free return, it's quite attractive for global investor to focus. I give you some of the example. Yeah, investor will likely to focus on the risk-free returns in the country that provide the highest. They will focus on the highest risk-free returns country. So means that investor will mostly focus on country that have high interest rates, because if they are going to save their money in that country, they are likely to gain a higher return. So I give you some comparison. If you are, for example, like Malaysia, I'm a Malaysia investor. If I'm from Malaysia, I'm going to save money in Japan, or I'm going to save money in US now. So right, if I'm going to decide it, whether I'm going to save my money in US or save money in Japan, I need to understand if I save money in Japan, what's my return? Or if I save money in US, what will be my deposit rate, or what will be my profits from saving it? So if we are going to look in the global market now, you could see that from Bank of Japan point of view, the Japan central bank maintain their interest rate between 0 until 0.25%, which means that if I'm going to save money in Japan, like I'm going to save $1,000 in Japan, I will only get like 0.25% only. If we convert, we might only gain like around $2.5. That's it. But if you are going to save $1,000 into US bank now, with the US central bank now is around 4% or 4.5%. If I'm going to save money with $1,000, I'm going to get around $45. So as comparison, both of them are risk-free returns. There are no risk because the probability for the bank to go default, to go bankrupt will be much lesser, right? So when you do a good comparison, of course, you are going to invest in US since they provide you a higher risk-free returns. So in general way, I simplify it that a country with high interest rate expectations will likely to attract more foreign investors to invest in their country. Or in put it simple, high interest rate will attract investors to save their money into the bank. So we come into the real life example, which is the USD JPY now. As you can see, right, previously, after the coronavirus issue, then after the economics after there is a vaccine news and Russian and Ukraine war, US inflations become all-time high. So after that, we could see that a lot of Federal Reserve, the central bank for the United States, decide that they are going to increase the interest rate significantly in order to control the inflation. And then, meanwhile, if you look at the Bank of Japan side, Bank of Japan claimed that they are not going to increase the interest rate while they are going to maintain a very, very low quantitative easing program, or as well as a very, very low interest rate decisions. So when you make a comparison from global investor, you could look at the chart. So a lot of investors turns their saving from Japan into US. So you can see that the overall trend since the Federal Reserve claimed that they are going to increase the interest rate significantly, the overall trend for USD JPY increased. Why? It's mostly due to after they increase the interest rate in the United States, a lot of investors try to turn their portfolio and put saving in US to gain a higher return. This is the real life proof. So this is the main reason that causing the pair USD JPY increase. So a lot of investors invest in US dollar appreciates significantly, and then the Japanese yen drops significantly. A lot of investors think that I'm not going to save money in Japan anymore. I'm going to withdraw my money, take my money out, and invest in other central bank. Put in US central bank. So this is the reason why this USD JPY pair increase significantly. So because USD go up, JPY go down. This is the formula here for USD JPY. Why we refer to USD JPY? Because this is a good Fatiha ask. Because this is a very, very good example that can show you guys the importance of the interest rate. Because meanwhile, right, since the global central bank is already decided they are going to increase the interest rates previously, and then just the Bank of Japan, they are the only country, it's not the only country, the only major country that willing to maintain a very, very low interest rates. So this is a proof that high interest rate will actually attract a lot of foreign investors, causing the US dollar go up, while a low interest rate will likely to cause the foreign investment outflow, which means that people from Japan, they are going to withdraw their money and put into other countries. That's why Japanese yen drop and USD go up. So to answer your questions, yeah. So this is the real life proof. I will go through it later. So in case you guys have a briefly understanding about, or in future, if the central bank is going to increase the interest rates aggressively, then there will be higher chance for the currency to go up. Okay, so this is the central bank. This is about the monetary policy. In professional terms, we call that monetary policy. The central bank are willing to maintain the high interest rates or increase the interest rate. We could call that the central bank is going to maintain their restrictive monetary policy. You might look at the news. Sometimes the news will like saying about the restrictive monetary policy or easing monetary policy. There are things are quite, you need to think it as a simple way. Restrictive monetary policy means that increase interest rate. So increase interest rate means that there will be a chance for the currency to go up. There will be a chance like that. So that's for the importance of the interest rate. So now you already understand what is the importance of the interest rate, which is the key issue for all those investors to know, because you need to know the interest rates, and then it will help us to predict what's happening in the market, right? So you know the importance of interest rate now. So we are going to go through everything about how can we predict whether the central bank, whether the Federal Reserve is going to increase the interest rates or they are going to decrease the interest rate. This is all those. This is the interesting story now. So from investor point of view, we need to try to predict whether the central bank is going to increase or not. So if they are going to increase significantly and we predict earlier, then it will be increase the probability for you to gain a greater return. Okay, so by understanding the interest rates, it might enhance your trading portfolio in future. So after we understand the interest rates, for now, we will discuss something about how does the central banks decide whether they are going to increase the interest rates or decrease the interest rates. So the first thing they are going to focus at is about inflation. Go deeper on the prediction part. I will go through it later, don't worry. Yeah? And then, okay, so I continue. So before we go through the interest rate things to predict whether the central bank is going to increase or not, we need to understand something about the inflation first. So why does the central banks want to increase the interest rates, or why does the central bank want to maintain a low interest rate? It's mostly due to the inflation. The inflation can consider as a main objective for the central bank to focus. So I know some of people might not understand what is the inflation, so I'll explain a few things about it. So inflation is something like price of the goods sold. So it means that if the inflation is very high, the price of goods sold, the price of everything is going to increase significantly. For example, previously, if you are going to focus on 1980, by using 100 US dollar, you are able to purchase a lot of things. But compared to now, 2018, by using 100 US dollar, you are going to only purchase a very, very small thing, very few things. So inflation becomes serious, means that a lot of people will suffer from it, especially when your salary do not able to cover with the price of the things that you want to buy. A lot of people will suffer. That's what we are suffering right now. I will discuss it deeper later. And then two ways. Now you already know inflation is like price of the goods. So everything that have price will link to inflation. So we need to understand what driving inflation, what causing the price increase significantly. I put in a summary to you guys. There are two ways to understand why are we experiencing quite high inflation recently, and how can we react to it. And then the first thing is demand pull inflation. From demand pull inflation, it's mostly like a lot of people come out and do their spending. So a lot of people spending, the consumer demands, the goods and services demand will go up. So with higher demands, the price is going to increase significantly. We can link back to previously after the coronavirus issue. We all have vaccine, right? So after coronavirus issue have been solved, a lot of countries decide to reopen their economy. And then when they reopen their economy, a lot of people will come out and travel. When they travel, and they will use up a lot of their money. They will spend a lot. So when a lot of people is going to do their spending, the price is going to go up because the inflation rate is going to go up significantly. So when the inflation rate is go up, a lot of people will suffer from it. This is from demand pull side, which means that something like increase of consumer spending causing the price go up. The second thing is about the supply push inflation. From supply push inflation, we need to link back to some production things like raw material price. So the reason most hot topics is regarding the Russians and then the Ukraine's war. And then the Russian and Ukraine's war. So for supply push inflation, previously, I think you guys still remember, Russians are having war with Ukraine. Then after that, a lot of EU country, European Union's country, decide that they are going to impose a lot of sanctions to them. So when they are going to impose sanctions to them, they will affect the oil supply. They will reduce the oil supply, which means that Russians are more difficult to supply the oil to other countries or others. And you guys know Russian can considering one of the wheat exporter in the country, wheat linked to the food price as well. So when there is a war, the food price will be affected as well. So when the supply for the food decline, when the supply for the oil, supply for the natural gas decline due to Russian and Ukraine war, the price will go up. Since the products, if the products that a lot of people not able to purchase, it will become more valuable. More valuable means that more valuable means that the price is going to go up. So this is the two main things that causing the global inflation now. If you realize that a lot of news claiming that US inflation rise to more than 8%, and recently EU country, the inflation rate rise more than 10%, which means that everything you want to purchase the price increased quite significantly. So this is the thing that we need to very be careful. So after you know about the inflations, we need to know about the GDP. So you guys know two rules that affect inflation, things that causing the inflations that high now. Demand pull inflations, consumer spending, and then supply push inflations linked to supply chain bottlenecks, which is the Russian and Ukraine thing. So you understand what's happening in the inflation market now. We need to understand about the GDP, which gross domestic products. So as a central bank point of view, right, they need to understand about whether is it suitable for them to increase the interest rate or not. They need to focus on the economic growth as well, right? So for central bank point of view, they need to make sure the GDP must be higher than the inflation. So I give you a very simple example. GDP, you can think something like your own salary, and then the inflation is the things that you want to buy. So if the inflation is too high, but your GDP, your own salary is able to cover the inflations, then there will be no big issue. So imagine everyone's salary increased by 20%, but inflation is only increased by 10%. Nobody will suffer from it. If nobody suffers from it, the central bank will not take any actions. But if your salary, which means that the GDP for the economy, GDP, is considering lower than the inflation, means that your salary is lower than the things that you are going to buy, right? So when this thing happens, central bank need to step up because everyone is suffering. The economy are not able to catch up with the price increment. So they will come out and the central bank will come out and put some decisions. So here's the questions. If the inflation is too high, whether the central bank is going to increase the interest rates or reduce the interest rates. So this is the thing. So we are going to focus on high inflations now, since it's the most hot topic in the market now. So we can see that after the inflations reached around 8.6% this year for US, the Federal Reserve decided to increase their interest rates significantly. So why, when we increase the interest rates, the inflations were able to stabilize it? Why? So the first thing is, you need to imagine when the interest rates increase, means that first thing, your borrowing costs will increase as well. Means that when you are going to borrow money to purchase your car, you need to borrow money to purchase house. So this is all those things that will be affected. So with high borrowing rates environments, you are not going to purchase now, right? Because everything you need to pay the loan will be very expensive. So it will discourage people to borrow money from the bank, which means that they will discourage people to do their spending. So when the consumer spending slow down, we could expect, as we mentioned just now, right? Inflation keep increasing is mostly due to the consumer spending previously. But after they increase the interest rates, the consumer spending becomes slowed down. Of course, this is the time that the price, the demands for price goods and services will decline as well, that link to the price go down. So this is the thing that will be able to help us to stabilize the inflation. So I think you guys can get a big picture right now, right? Why the central bank wants to increase the interest rates. So they want to control the inflations. Why? Because when you increase the interest rates, higher borrowing costs, people are not going to spend. Low spending, low demand for goods and services, price go down, inflations go down. This is the first perspective. The second perspective is, as I mentioned just now, deposit rates, deposit interest. You can understand interest rates as a deposit interest, which means that if you are going to save money in the bank is going to pay you also. You can gain some return if you are going to save money in the bank. So when the deposit interest go up, when the interest rate go up, the deposit interest will go up. So which means that you are more likely to prefer to save money in the bank, because if I save now, I gain higher interest and gain higher returns. So you are more likely to spend money in you save money in the bank. So when more people are saving money in the bank, same thing, they are not going to spending. So less spending, demand for goods and services go down, and then stabilize. Then the inflation will be stabilized. Okay, then you are able to have some of the 50 US dollar deposits to clarify your $50 credit bonus. But I think the most important thing for today is for you guys to learn about how you're going to trade. So for 50 US dollar, same thing, you need to listen until the webinar finish, and our company will choose the 50 people, and based on luck. So, all right. Okay, chill, for the $50 credit bonus. Not worry, our company might have some of the promotion in future that you can stay tuned to it. But yeah. All right. Good luck to you all. I also wish I also wish all of you get a credit bonus, but it mostly depends on luck. So good luck to everyone. And then I will continue. Sorry, I go back to the questions later. So now you guys briefly understand what's happening in the market now. Because the inflation rate is too high, a lot of central banks decide to increase their interest rate. So when they increase the interest rates, I give you some of the best example, which is the US dollar. Previously, after the coronavirus issue happens, finished, the coronavirus issue solved. Okay, after the COVID-19 issue solved, people come out and do their spending. So when they do their spending, the inflation go up. So previously around 2021, the inflation in US is considering very serious. So the Federal Reserve decide to come out and then they decide to increase their interest rate significantly. So once the central bank turns their policy from previously low interest rate until they increase the interest rate significantly, like now until around more than 4%, you could see that the overall trend for dollar right actually go up significantly. So this is the reason that we need to understanding the importance of the interest rate. So this is all those news linked to the interest rate. So after the US central bank slowly decide to increase the interest rate, the overall trends for the US dollar keep going up. So I hope you guys understand the importance of the interest rates. Later we will go through like how can we predict whether in futures the Federal Reserve is will able to increase the rates or not. So this is the thing we need to focus on. But this is the real life proof that the importance of the interest rate that we need to focus. And why currently the US dollar dropped back is also due to the interest rate thing. Because for now, right, a lot of investors expect the Federal Reserve is not going to increase the interest rate significantly. So with this kind of expectations, they start to sell dollar. So we come back to our first logic. High interest rate expectations will actually cause the currency to have higher probability to go up. And low interest expectations, such as Bank of Japan's previously, will likely to cause the Japanese yen to experience some of the aggressive sell-off. Okay, so this is a brief understand. So for now, right, we are going to go through three major central banks and explain things about explaining about what's the Federal Reserve point of view in terms of interest rates, and European central banks, what's their perspective, and then like we also explain some of the Bank of England's what we need to focus on Bank of England in future. So first questions, will the central banks increase the interest rates significantly? So will the central bank increase the interest rate significantly? So these are good questions now. I think a lot of people are still suffering from this kind of topics because it's quite difficult for a lot of investors to fully understand everything. But don't worry, after today's webinar, you guys can learn a lot from it. So for now, right, from what we know, the US central bank has already increased the interest rate from previously around 0%, increased until now 4.25% until 4.5%. And from the FOMC meeting minutes previously, there still expects that there will be higher chance for the Federal Reserve to continue increase their interest rates until it reach 5.1%. So we are going to focus on 4.5% until 5.1%. You could see that there are still a lot of monetary policy tools that need to do in order to increase the interest rates. So there will be a lot of ways, a lot of pathway for them to increase their interest rates. So with this kind of expectations, we could expect there will be a chance for dollar to go up actually, but we need to be careful also because recently, right, some of the investors start to turn their point of view, even though a lot of Federal Reserve members come out and keep saying that they keep saying a lot of hawkish terms, saying that they're going to increase the interest rate significantly until the inflation rate reach until 2%. This is from their statement. But we could see from market right now, right, a lot of investors don't buy this kind of view, this kind of perspective from the Federal Reserve. They decide to react to the markets earlier. That's why you can see that a lot of investors start to profit taking from the US dollar. A lot of investors start to sell off the US dollar. Why there are a lot of investors to put this type of speculation? It's mostly due to if we are going to focus on the recent economic data recently, especially with growth from the United States, especially like manufacturing, non-manufacturing data, economic data from the United States. You understand all those data, and you can look at other country data as well. You can see that recently US, EU country, UK, as well as the Canada, recently, all the economic data has started to slowing down. So when the economic data is start to slowing down, it will reduce the probability for the bank to increase their rate, because if the economy is not good, you are going to increase the rates again. A lot of people suffer. Why? Imagine, if you are suffering, you are unemployed, you are not able to get a better job due to recessions now, a lot of people suffer, and then the bank still decide to increase the interest significantly, and you still need to pay loan, you still need to pay back a lot of money. So this is the things that we need to suffer. So a lot of investors start to predict that the Federal Reserve, I think, is not going to increase the rate that aggressively anymore. So some of the investors have started to sell off the US dollar. So as we can see, after the US dollar break out below the support level, the overall trends for the US dollar keep dropping. But in future, right, it's not a guarantee. It's not guaranteed that our previous economic data shows a negative reading. So I expect in future 100% Federal Reserve is going to not increase the interest rate anymore. It's not 100% guaranteed. That's why you need to keep looking at the economic data. So we can see that recently, a lot of markets will react aggressively to the economic data. There are very important data today, which is what we call the US CPI data, which will be released on Thursday, that you need to very be careful, because we could expect there will be a very huge movement for the CPI data on Tuesday. So why does the CPI data is very important? We need to link back. CPI data is, just now got people asking about the CPI data, right? So CPI data is what we link to. CPI data equals to the inflation data. So when the CPI data very high, it means that inflation in United States is very high. So the Federal Reserve will increase the probability for the Federal Reserve to increase the interest rates. Okay, so if they increase the interest rate significantly, it will causing the dollar to go up. And if the CPI start to reduce significantly, lower than economists forecast, then we might expect, there are a lot of traders will start to expect, now the inflation is slowing down. So the Federal Reserve, I don't think the Federal Reserve is going to increase the interest rate that significantly, or maybe even maintain a very low interest rate. So this is the thing that will cause the US dollar to drop significantly, and other currencies other commodities such as gold to go up. I am not going to answer whether the CPI is very good or bad, but I would suggest you guys to 100% focus on these types of news and put your own independent thinking. If you think that currently a lot of people suffering recessions now, and then there will be a chance that inflation, the price will start to decline, then you might considering to short sell the US dollar. So it depends on your own independent thinking. But if you think that currently there is a Russian-Ukraine war, and then the price for food, everything is going up, and then China is going to reopen their economy, so you could expect the inflation, the consumer spending is going up. So there will be a chance for CPI, provide some positive reading. You can go ahead with your trading strategy. So it is very important that you are not affected by everyone, but you need to fully understand what's happening in the markets, and you try to slowly digest about it. A lot of people say that maybe, some people say maybe Jerome Powell will tell you why later. But for normal investor, I would likely to suggest you guys to put your own independent thinking because it's very important for all of you. So you need to understand the CPI thing, and then the inflation thing, and then you need to understand about the interest rate thing, and then how can it affect the currency. So this is the most important topics that are happening in the market right now. Okay, so then we are going to continue. So you guys can get the point of view from the Federal Reserve to decide whether they are going to increase the rate or not. So, but if you're going to focus on the market news, market speculations, according to FedWatch 2, you could see that a lot of investors start to speculate the probability for the Federal Reserve to increase their interest significantly has started to decline. So they only expect the Federal Reserve to increase only 25% basis. Or 25% is less. When the rate hike decision is less than previously expectations, it will actually provide a lot of bearish momentum towards the US dollar. As you can see that according to FedWatch 2, more than 70% investors expect the Federal Reserve is not going to increase the interest rate that aggressively. It's only increased by 25%, 25 basis points. So this is why you can see that's the overall trend for dollar. No matter you are using daily charts, you can see that it still dropped significantly after market react negatively to this news. Okay, so regarding the CPI data, I can open it for you guys to see. So this is the main event I think we need to focus, or the global investor need to focus, which is Thursday, the core CPI data as this type of data will be released as GMT plus 2 time around 3:30 p.m. This is the major news that we need to focus. And then, yeah, so we are going to continue. Sorry, I will go back to all those questions later. Yeah. So now we are going through about the European Central Bank's point of view. So if you are going to look at the chart, right, you can see that overall trend for US dollar actually dropped significantly. But if you are going to compare other currencies such as EUR/USD, GBP/USD, you can see that overall trend for this euro, especially euro, yeah, is very, very positive. Why does it happen? The first thing is, as I mentioned just now, right, recently euro actually just released their inflation data. And if you are going to compare the inflation data between European country and US country, it's quite obvious that currently European zone, their inflation is much higher compared to the US. So if you are going to put some interest rate expectations, you might expect that because of the Eurozone inflation is very high, you might expect that the European Central Bank is going to increase the interest rate significantly, more significantly compared to the United States. So this is why after those types of inflation data come out, after US data come out, after Euro data come out, after the investor makes out of the comparison, they are likely to predict that the European Central Bank is going to increase their rates more aggressively compared to the dollar. So this is the thing that happening in the market now. But if you are going to focus on Euro trades, right, EUR/USD, you need to 100% focus on this crucial resistance level first around 1.0765 around these regions. I would suggest you to consider buy after it successfully break out, but before that, you still need to be careful before you entering the trades. Focus on several things from European central banks as well as the interest rate, as well as the resistance level around here. Okay, so these are the comparisons between the Federal Reserve and then the European Central Bank, and this is also another reason why after we compare everything, you can see that it's quite obvious some of the investors start to allocate their portfolio from the United States to other countries such as European regions. So this is the proof. And then we are going to focus on pound, UK also. As we know, right, currently, if you are going to compare the inflation rates in UK, we can see that you can just focus on the CPI data. For November data, right, UK inflation reached 10.7%, but comparing to US, actually when you do some comparisons, same thing. You compare US and then UK, you can see that it's quite obvious. The UK inflation is quite higher compared to the United States. So this is also another reason that supporting a significant sell-off for the US dollar as investors try to shift their portfolio from dollar to other pairs such as EUR/USD, such as pound sterling. But if you are going to do some comparison between euro as well as the pound, we could see that the overall trend for the pound might not that positive compared to euro. It's because of some of the investors might still worry about whether the new UK Prime Minister Rishi Sunak is able to manage his country well or not. So this is a thing that we need to be careful compared to euro. But if you're going to trade euro, you also need to digest a few things about Russian and Ukraine thing. It's not 100% guarantee that interest rate will 100% causing the euro to go up, but you need to bear some of the risk if you are going to trade euro, because recently we know Russian and Ukraine are having war. If the European regions decide to impose more aggressive sanctions towards Russia, then we could expect it will affect the euro economy as well. So it will provide some bearish momentum for euro. So this is the thing that you need to be careful. Okay, but if we are only focused on the inflation thing, after you compare US UK as well as the EU, it's quite obvious that investors are quite bearish towards the US dollar because US for now are expecting a low inflation, are expecting the inflation has already reached peak. So the probability for the US central bank to continue maintain their rate hike decisions will be much lesser. So a lot of investors digest to it. But really, just a kind of reminder, the previous economic data doesn't mean in future the US will maintain like this. So my advice is you guys still need to 100% focus on the economic data. So each time US data come out, inflation data, employment data, all those data come out, it will just directly affect the movement for the US dollar. Okay, so this is the comparison. Okay, so this is the question now. How can investor determine the monetary outlook? As I mentioned just now, first thing, you need to understand that whether in that country, their inflation, is it high or low? Is the inflation higher than the GDP? Is the salary in that country, the salary increments is better than the higher than the things that they are going to buy? So inflation thing is very important because central bank is going to look towards it. If the GDP is much lower than the inflation in that country, then we could expect the country will not increase the interest rate significantly. And if the inflation rate is much higher than the GDP, high inflation rate, then we could expect the central bank will come out and increase the interest rates in order to control all those inflation things. So data-wise is very important, especially inflation data. So inflation data, more professional terms, is like CPI data, consumer price index data, PPI data, producer price index data. So this is the main thing that you need to focus. And it's not only data side. It's other things is very important, such as central bank meeting minutes is also important because this sometimes the central bank will discuss about whether they are going to increase the interest rate in future or not. What is their expectations towards the future inflations as well as the interest rates? So normally, to simplify it, central bank meeting minutes will provide you guys some of the signal about what the central bank is thinking now, and investor will try to use up those meeting discussions from the central bank to predict what are their futures monetary policy decisions. So central bank meeting minutes is important. You can also refer to the news sometimes. And then MPC statements means that monetary policy commodity, like Federal Reserve member, sometimes they will come out, like just now a lot of people mentioned about the Jerome Powell. Sometimes Jerome Powell will come out and provide some of the statement. But you need to be careful. Sometimes Jerome Powell will provide some statements like very neutral. Sometimes he will also provide statement like very aggressive. So if you are very interested in trading, then you need. I would suggest you guys to wait until his statements and then to decide whether you are going to buy now or not. Because especially from human statement, I think it's quite impossible for everyone to predict what are they going to say. So better, same thing we apply to fundamental and technical thing. From fundamental point of view, you need to understand the storyline about what the Jerome Powell said. And then after we fully understand it, we're using the technical analysis to decide which currency is the best for us to trade. Okay, so MPC statements is something like Federal Reserve statement. And then monetary outlook. Sometimes the central bank also release some of the monetary outlook discussing about the inflation forecast, GDP forecast. This is also the thing that you need to be careful. And then press conference. So after the monetary policy decisions, after the central bank decide whether they are going to increase the interest rates or reduce the interest rates, there will be a press conference. In the press conference, they will talk about why are they going to increase the interest rate, and then in future, in what circumstances they will continue to maintain their high interest rate decisions. So press conference is also the things that you need to focus on. But same thing, don't try to predict what are they going to say during like press conference, MPC statement. Don't, because you're going to do that means that you're going to trade before even these statements come out. And I think from my point of view, it's quite impossible to predict what the person is going to say in future. It's very difficult. So for better understanding, we try to understand the economic data first. And then from the economic data side, we slowly predict what the Federal Reserve will say. Sometimes even the economic data like inflation is too high, but sometimes the central banks, the Federal Reserve member will come and say, I don't think inflation is very necessary. So it's not the main thing that we need to focus. And when that time happens, your trading strategy, your trading portfolio will have will experience a significant volatility. I would like to say that. So better wait until that statement come out before you do some trading. So I think that's it